I want you to imagine that this is a dividend stock. Now, it doesn't take sick leave, it doesn't complain, it always comes to work on time, and is super hardworking. And best of all, it always brings me free money every once in a while. And with this free money, I can hire another dividend stock. And with these two dividend stocks working for me now, I can hire even more dividend stocks. Some big ones, some small ones, some cute ones, and in the end, I have an army of dividend stocks working for me, bringing me cash every once in a while. And it all started from one dividend stock. Hi guys, welcome back to my channel. Kelvin here. Today, I'll be sharing with you 6 amazing facts about dividend stocks that will blow your mind and how it can help you in the dangerous journey of investing. But before I proceed, if you are new here, do subscribe to my channel. I post every Monday talking about personal finance like credit cards and investing. Tap the bell button to get notified every time I post a new video. Without further ado, here's fact number 1. Dividends have accounted for most of S&P growth. Let's say if you have invested $100 at the end of 1940. At the end of 2011, your $100 will be worth $12,000 now. Let's use the same scenario, but this time, you reinvest all the dividends you have received. And now, at the end of 2011, your $100 will be worth $174,000. Yes, in a study by Ian Mortimer and Matthew Page titled Why Dividends Matter, what they found out was that S&P since 1940, dividends have accounted for over 90% of the total return. Now, this is even true for the low growth periods like the 1940s and the 1970s, where the economy was bad, mainly due to the war, rising inflation, increasing in oil price, and high unemployment. Dividends in those periods have accounted for over 70% of the total return. This is to say that reinvested dividends has managed to outperform price appreciation of the stock most of the time. And that is why I always make it a point to reinvest all my dividends, because at the start, it is just one lonely dog working hard for your money. And every time you reinvest, you gain an additional worker, and an additional worker, and soon you have an army of dividend stocks working for you, bringing you more and more dividend money. And that brings me to fact number 2 of dividend stocks: power of compounding. When you hear a dividend stock having only 4% yield, that means for every $1,000 you invest, you only get $40 per year. And you might think that it is very little and it will take 25 years to earn back your $1,000. In reality, it doesn't work like that, because when you reinvest your dividends over the long term, you unlock a hidden benefit of investing. And it is a very powerful phenomenon which Einstein himself has said that it is the 8th wonder of the world, called compounding. Anything that can compound will grow at an exponential rate. So in reality, you do not need 25 years to earn back your capital. Assuming that the price of the stock doesn't go up, dividend doesn't increase, and inflation doesn't exist, you will only need 18 years to earn back your capital instead of 25 years. And the more years you allow your investments to compound, the stronger effect you will have. It's kind of like Mega Man's Mega Buster. The longer you hold it, the more powerful it will be. There is a saying, the best time to invest was yesterday. The second best time to invest is today. So invest as early as today, so that you can make full use of the compounding effect. Fact number 3. Dividend companies fall less hard during a recession. Whenever a recession hits, you can expect that the earnings of the company will drop. But did you know that during a recession, dividends doesn't drop as much as the earnings? Take for example, in the 1973 recession, earnings per share dropped by 15%, while dividends per share dropped by only 1%. Next, 1981 recession, earnings per share dropped by 19%, while the dividends per share didn't drop at all. And in the 1990, earnings per share dropped by almost 32%, while dividends per share, same again, dropped by only 1%. In the 2001 recession, earnings per share dropped by 54%, while dividends per share dropped by only 6%. 2007 recession, earnings per share dropped by almost 92%, while dividends per share dropped by only 24%. And best of all, when the economy recovers, dividend companies recover much quicker too. You may ask, why? Why is that so? What makes dividend companies so special? You see, dividends are a reflection of the company's earning power, and it is usually set at a sustainable payout level. And because of this, companies usually won't cut their dividends unless they really have no choice. The other reason is, dividend investors like me prefer to invest long term because we want to take full advantage of the compounding power, in which the longer we invest, the faster our returns will grow. A dividend investor will prefer to hold long term because they have more patience and they have more holding power, and they would rather hold the stocks through all the ups and downs. And you know, there is a saying, if you cannot accept me at my worst, then you don't deserve me at my best. And yes, it applies to stocks too. Trust me, I'm a long-term dividend investor. And fact number 4 of dividend stocks, you should always help to tap the like button to help support the channel. All jokes aside, fact number 4, income is not reliant on price. Dividend investors do not rely on stock price to earn money. And this very fact gives me the confidence to invest in the stock market and allows me to sleep well at night. Because I know that regardless of the stock price, whether it goes up or it crashes down, I will still get a steady income no matter what, assuming the company doesn't cut its dividends. In fact, if the company is strong and the management is extremely capable, over the long term, dividend payouts will also increase. And that is also why dividend investors are extremely excited when the price of their stocks fall by a lot. Just like the other day, when the stock market crashed by over 37%. You would think that dividend investors are worried. Yes, of course we are worried, but we are not that worried, because we know that dividend stocks are more resilient to market downturns. We are glad too, because this means that we can buy more of the same stock at much cheaper prices, which in turn will give us much more dividends. And fact number 5, dividend companies are more transparent. Dividend payout usually signify good management. Now, I'm not praising them just because they are giving me free money, which they are. What I want to say is, to be able to pay dividends, company must have cash on hand. And you can't fake this through creative accounting. Companies can and sometimes fake their financials to make it look nicer and more rosy, and it happens more often than you think. However, dividend companies can't fake paying cash dividends to investors because, in the first place, the cash dividends must exist for them to be able to pay it. And because of this, paying dividends over the long term gives investors confidence in the company's financial health. Dividend companies are also subjected to stricter checks and balances because the shareholders are now more concerned on how the company spends the extra cash. Let's say the company decides to do something funny, like buy 1,000 expensive car and launch it into space, just for laughs and giggles. The shareholders will quickly step in to prevent that from ever happening. All in all, dividends makes the management more accountable to its investors. And fact number 6, dividends hedge against inflation. If you have held $100 from 1947 up till now, this $100 would now worth just $10. And if you have put this $100 in a high-yield savings account, giving you about 2% annually, in 20 years, after inflation, this $100 will still worth $100 because of inflation. But if you have invested your $100 in the dividend stocks of 7% yield, after inflation, your money will still worth $105. So, by investing in a dividend company, your money actually grows much faster than the inflation, effectively hedging against the inflation and preventing your money from losing its value. Now, even though investing your money will grow your money much faster than the inflation, you should only invest money you don't need for the next 5 to 10 years. This is because stocks are extremely volatile. In the short term, the stocks will go either up or down, totally at random. but in the long term, all stocks will reveal its true value. And you, one day, will have your own army of dividend stocks investors working for you. And that's all for today. Comment down below, let me know what you think about dividend stocks. Like, share, and subscribe as I post every Monday talking about personal finance. See ya!